I always respect people who write macro research who've been in the markets. And that's why, for example, I love chatting to Christophe Olari. Christophe is a great trader and now writes great research. And Juliette is also one of those. She's somebody I really respect. Her opinions are always very poignant, often variant, and she's often very right. So I wanted to dig into her and find out her view, because I've been seeing that she's thinking about a soft landing for the US. And I want to know what that means and what the opportunities might be, because that's a very different view to most. Most people have a very negative view on the US and globally. So let's find out what Juliette has to say, because I think it's going to be interesting. Juliette, fantastic to get you back as ever.
It's great to see you too, even if a little bit hungover. But I will.
Shh, we don't tell anybody. So just to give a little bit of background about yourself, and then we'll start digging into the whole thing.
Sure. So I founded JDI Research in 2016, and my work really revolves around advising a whole bunch of investors, traders, mostly on the institutional side. What I focus on is a lot on macro charts. What I really like is not to write pages of what I think, but actually show you what's happening. And, that's a framework that's been very successful for the past 7 years, and which has allowed me to call a lot of the really important turning points. And, that's why I'm still here today after 7 years.
And it's why I wanted to get you back on.
Yeah. And as you're wrong 2 months and clients start to be like, this is rubbish. You're always as good as your last call, right? Which is what's difficult.
It's a fickle business, but yeah. There we go. But that's why I love getting you on, because I love picking your brains, because you're a great thinker. You've got some great experience. So give me the big picture view of where we are right now. Where we think we are.
So, the big picture view, basically all year, my view has been that the US was going to be extremely strong, and which would basically mean soft landing, because the rest of the world was basically so weak and actually getting weaker because of the Fed itself. So on the US side, you've got a virtuous circle where basically the Fed being tight and the dollar being strong basically sends very strong deflationary pressures on the US economy, which you are starting to see signs is actually benefiting the consumer. So, for me, the move from Q3 to Q4, and you can see it in many charts, is the fact that you're starting to see a release of purchasing power from global disinflation, global lower commodities, and obviously the stronger dollar. And that's basically transferring into a stronger services sector. So that you had really, on one side, a really virtuous circle in the US, and an extremely vicious circle in the rest of the world, where obviously we were hit, Europe was hit by extreme, energy crisis, and much more by supply side shocks, and obviously China is still basically bending under the weight of the property sectors and deleveraging in the property sector. So what really was worrying me, until last month, was the possibility of a dollar black hole, where basically all central banks in the rest of the world outside of US have to basically tighten and over-tighten because, of the strength of the dollar and the fact that global deflationary forces were mostly benefiting the US. If you're looking at the commodity index, the Bloomberg commodity index year on year, we're pretty much flat in the US, but for the rest of the world, we're basically still up 25%. So you are basically stagflationary forces hitting the rest of the world. And luckily, my view has been that inflation would come back down, almost as fast as it came up. in the US. So we are now getting relief on this side, which is the report that I warned about the pivot last week. And I think it would be really interesting if you're interested to look at a few of the models that I'm looking at on that, because it's crazy that the Fed is getting it wrong.
Yeah, so we will show some of these charts as we go through them, but talk to me a bit about where the Fed is getting it wrong and how you see this playing out in 2023, because we're starting to see the market sniff out a change.
So I think, take the first chart in the email that I sent you. It's called in late 2020, early 2021. It did not take a PhD to know that something was up about inflation. Now, I'm not even looking at the sort of like indicators that we both like, leading indicators, because inflation is such, the mother of all lagging indicator that you can very easily forecast it with coincident leading indicator. So on my charts, I actually used, simple retail sales deflated by, core CPI, and moved it forward by 15 months. Now, that's exactly the chart that you would have seen in early 2021. I was already calling for reflation since March 2020. But at that time, it was still, in 2020, it was more about speculating about reflation. In early 2021, you were no longer speculating. It was very clear that you were going to get a burst of inflation. Yet, the Fed waited another pretty much 18 months. I mean, they started to worry about it like a year later, and basically waited for 18
I cannot believe the Fed trade headline inflation numbers or headline economic data when the rest of us can see all of these things so far out. I didn't think inflation would go this far. I mean, this is a killer chart, but we kind of know, and we know that it's rolling over, but they just don't do it. It's really weird. I don't know what their PhDs are all worth.
I think they're getting the lags completely wrong. And I think it's quite human, right? When you know something will happen, it's really difficult to understand and put your head around why it's not actually happening. Because at the time, obviously, core inflation was at 1.6%. And they were basically obsessed about basically waiting for realized inflation to pick up after years of disinflation. And I think it's exactly what's happening today. So if you're looking at the second chart, which is actually today's chart, and is called, "Please someone remind Powell macroeconomic models are not broken," you will just have to take into account the long but actually stable lag between activity and inflation. And you can see basically that inflation is coming back to 2% with the same lag as it went up 15%. And I think what markets were really waiting for is the turn, right? The peak. I knew it was going to be either this month or next month. Lucky it was this month, because it could have been carnage in between in my recommendations. But
what that chart tells you is the speed of which inflation is going to decline as well. That's a really sharp fall.
And historically, that's always the way inflation is falling. And there's many reasons this happens. In fact, if you're interested, we can talk about the supply-demand model, which I think is fascinating, because we all learned it at school and probably never thought that it would be useful. But I think it's been really useful to me in this sort of like macro cycle. And that's the supply-demand chart, which is called "Pandemic Inflation was a textbook response to coincident supply and demand shocks, with the resulting equilibrium price setting on the inelastic part of both curves." So basically what you had is basically a move on both sides on the completely inelastic parts of both curves. And you basically get price equilibrium, which is basically setting on the part of the curve where you will get absolutely no move in production because there's no capacity, and everything will basically make prices explode. Now, the beauty about that chart is when those shocks sort of dissipate, you basically fall back you basically still on the elastic part, and what you should be seeing, and that's what I've been calling really, is what you will see is prices completely collapse, but you will not need much of a drop in production, or in fact much of an increase in unemployment, because really it's like purely a price move. And that's what I've been betting on. I don't see any reason anything would be different this time. For me, it's really textbook macro.
Yeah. Also, for me, it's so similar to 1946 and that period afterwards, but that was an even bigger, exactly the same supply and demand shock. All the factories were making ammunition or had closed down in Europe. Everybody comes into the civilian labor force, goes to work, buys stuff. There's nothing to buy, prices explode, go up 20%. And inflation was negative 2 years later, and then had a rebound effect.
And I see that as a potential.
Yeah, I do too.
Yeah. I mean, cyclically, I think it's very possible that we see deflation in the next 2 years. And one of my recommendations is actually to short 2-year break-evens. I'm calling for a soft landing, but that doesn't mean that we can't get a much bigger hike, a much bigger shock on inflation. I mean, it's just almost like a natural, right? You basically increase prices when you've got pricing power, and then you lose pricing power. You've got massive inventories, and you're sort of like stuck. And the next thing you do is going to have to cut prices. And I'm not saying we will unwind the price increases that we've seen over COVID, but I don't see why we can't see a year-on-year deflation in 2020.
Yeah, because even if, let's say, oil, let's say, stays at $80, well, by some point next year, oil is negative 50% or 40% year on year. So these things drive the numbers massively.
Yeah, that's the joy of cycles, right? I mean, you don't really have cycles where you don't basically mean revert. Is actually quite rare. And the way we wouldn't be reverting on inflation is if basically the Fed slashes rates, but that's not really on the cards anytime soon.
So let's go to that chart about let's go to that chart. Historically, the Fed always pivoted before a peak in inflation.
Yeah, I mean, I think that's really interesting. Like all you've been seeing, all you see on Twitter since yesterday is like, oh my God, come on, inflation is still at, core inflation is still at, headline is still like above 7, and core inflation is still above 5. I mean, you're not going to see a pivot anytime soon, and that's so completely wrong, and wrong also historically. If you look at the chart that you just pointed at, you can see that even in Volcker's year, you were always pivoting as the Fed before the peak, because you're basically looking, because it's such a massive lagging indicator, and you're basically looking not only at the leading ones, but obviously the fact that at that point, you probably already seen a rise in unemployment. And so the Fed normally pivots with a very small rise in unemployment, but still like months before the peak in inflation. And that also applies to Volcker's year. So unless Powell is going to be basically much more hawkish than Volcker, in which case he's going to have to spend the whole next year apologizing about your job, after he spent the last year apologizing about your loss of purchasing power, which I don't think is really his goal, then I think a pivot is basically in the next. I think it will happen in the next quarter.
And when you talk about a pivot, because we all talk about different things in a pivot to you is stopping or starting to reverse.
So for me, it is stopping. Right now, I'm still really like looking for soft landing in the US. I don't see major vulnerabilities. I think the reason the economy is obviously a lot weaker, but not weak, is obviously the rise in real rates and the unprecedented rise in tightness in financial conditions. So, for me, you can basically rebalance that pretty easily. So I'm just looking for now, for like a pause in hikes. I don't think we're going to hike even after yesterday's move. I don't think we're going to hike as much as what's priced in the market. But I prefer to be long equities because I'm not seeing yet the necessary forces to basically start looking for cuts. Now, you know what? It can happen in a matter of months, and we've seen in the past that I think the median time between basically stopping hiking and starting to cut is something like a couple months. So, that's something that we have to bear in mind. And a lot of my clients are like, on red alert for like, basically looking for like a sort of a massive unwind into 2023 of the of the increases we've seen in 2022. But for me, it's not the trade yet. And what I'm looking at really is, easier financial conditions, an economy that is still massively improving on a cyclical basis. There's a chart that I really like, which is the last one that I sent you. It's called "The Trading Environment Remains Aggressively Pro-Cyclical, with equity internals now catching up to higher real yields." The reason I like this chart is because it's allowed me many times to call a pivot. And when the Fed basically over tightens, you suddenly see like cyclicals versus defensives collapse, and in a matter of 6 months, basically the Fed pivots. And you can see that's happened in 2015, and it's also happened in 2018. What's happening this time is completely different. Instead of seeing like the cyclicals versus defensive ratio, which I think is an excellent gauge of where equities think we're going in terms of like near-term cyclical forces, and you actually have like that indicator actually catching up to higher real yields rather than collapsing, which means basically there is no cyclical pain ahead, or at least it's not priced.
Could that be because of the energy sector, because the structural supply imbalance there, that it's kind of hiding the cyclical signal from the economy because of supply issues? Could that be possible?
It's possible, but I think, there's other charts that I'm looking at that are a bit similar as well. The fact that the overall equity risk premium is still rising, is still basically tightening as well, and more, which means that relatively stocks are still like strengthening, even if you take into account the increase in real yields. That's another thing that's completely different from 2018 and 2015. And I think that wouldn't be disrupted by the move in energy and energy supplies. But I agree, it would be probably interesting to like take out energy. But it's not only energy that's been overperforming, right? Industrials have been outperforming as well. So I bet if I take energy out, it will still be
it'd be interesting to know. So the soft landing. So if we have a soft landing, where do rates settle in this? Do rates stay higher? Does inflation revert? Where's your kind of structural thesis here? Because if we get a soft landing, people are like, well, the Fed are never gonna cut rates. They're going to keep conditions tight. But you and I both see inflation heading down below Fed funds in the next 6 months. So therefore, it'd be abnormal to have it so tight. How are you seeing this whole thing? So therefore, rates follow inflation?
Where we are right now, in terms of like coincident, neutral nominal yield, is probably neutral. I think the Fed is quite keen to go restrictive, and that's what will happen with potentially the next, let's say, 75 basis points, 50 plus 25 in early next year. And then, at some point, obviously, you will have the COVID liquidity completely withdrawn from the economy, which is potentially not going to happen before the end of 2023. I think there's still a lot of flushed liquidity. In terms of the housing markets, personally, I don't know about what you think, but I don't see at all the vulnerabilities that we had in 2006, 2007. I think supply is extremely tight still, which means, again, we're going back to my supply-demand chart. Basically, the adjustment will be in prices, but are actually saying that the construction sector will not crash. So you'll have sort of like the rebalancing, sort of normal macro rebalancing, but actually the US is by far the least sensitive to higher interest rates. Also, obviously, because mostly I think it's 96% mortgages that are basically 30-year mortgages fixed. And that means basically only newcomers in the mortgage markets are going to be affected by higher yields. So I think if we sort of like stabilize here and start drifting back down, I actually see soft landing in the housing markets.
So I can frame it. Where do you think, with a soft landing coming, inflation coming off, where are Fed funds at the end of 2023?
So I think, probably, Fed will be happy, with their lagging, indicator coming down. You and me are going to be like, oh my God, we're headed to deflation. And suddenly the COVID liquidity gets flushed out. You start to get really, there is like basically an 18 months lag between monetary policy and the economy. So I think we're actually not seeing much. We're not actually seeing all of the monetary tightening actually hit the economy in 2023. So I think for me, it's more like a 2024, maybe late 2023. Equities are really pricey, and then suddenly, we're headed to deflation. Liquidity is gone, and that's when potentially the Fed starts having to cut really quickly.
So you think,
in a reverse move to the liquidity move that we had during COVID, I think that could be like a really fast, but more like towards the end of 2023 than anytime
so you
soon.
think rates would be on hold for 2023?
Yeah.
Interesting. And so with the soft landing idea, you're therefore bullish equities. You think that's the best expression of this view?
Yeah, I mean, actually, what I'm recommending is Europe and emerging markets. I think, for the cyclical reason that we discussed earlier. And of course, the fact that rates are not going to collapse in my scenario means that, NASDAQ is probably not the best exposure to get. You probably want value cyclicals rather than growth stocks. And I think there is much better value outside the US than in the US. So, that's why I'm actually looking to position for equities outside the US.
And I'm presuming you're thinking the dollar goes lower.
And I think the dollar goes lower in a knee jerk to the, what we've seen happen this week. Obviously, the pivot is clearly makes market price out the sort of like the right side of the smile, where the dollar goes up because of the global recession. So I think we need to price that out. Obviously, dollar is like massively counter-cyclical. And, I think we're reverting to the middle of the smile in the next couple weeks, possibly just couple days. But what I still see ahead is that the US is still massively outperforming the rest of the world. I think, we're exiting that sort of like softness in the cycle much faster in the US than in the rest of the world. So I think the dollar could start strengthening again on the other side of the smile, which is just purely because the US is outperforming the rest of the world. So I think we're moving from like sort of like disaster scenario, like dollar black hole, to basically the dollar is going up because the US economy is the least vulnerable by far to like the move higher in interest rates. And, in case of Europe, we're obviously talking about not vulnerability to interest rates because, France is pretty much the same as the US, and Europe as a whole doesn't have much of a vulnerability to mortgages. Different story with UK, of course. But for example, Australia, as you know, is like massively vulnerable to higher rates, and Europe is massively vulnerable to an increase in energy and commodity prices. So it's sort of like the region that is benefiting somewhat from like the second pivot that we haven't talked about yet, which is obviously China coming out of the zero COVID policy. So on one side, you've got the plus of like the manufacturing sector being revived and generally like a cyclical uptilt. On the other side, it's a bit of a disaster if nat gas prices and energy generally start to come back up. And we haven't had this issue yet because I'm in London today, and we're mid-November. Literally, it's still 19 degrees. I'm wearing like short sleeves. So we haven't needed, so basically like storages are still like, full up. But obviously that's something that can change and get priced really quickly because there is still no plan for 2023, 2024 in terms of like heating and energy sovereignty.
So as China comes back on, whenever that is, and we're already seeing liquidity in China going up and Chinese M2 going up and, credit going up in China. So when that comes, we have another rebound effect of inflation through again, kind of like the 40s and early 50s where we had this big spike, it went back negative, it came back again for the same issue, and then eventually settles back down. So you think that's how it's going to play out, that we've got to probably, when everybody comes back into the economy, we probably get a pretty short cycle again?
I'm not sure about that because, as you say, commodities can make new highs without hitting inflation, right? Yeah. But on a year-on-year basis, I think we can actually have like as long as we don't have a shock, which obviously I can't rule out given what's happening in Russia, Ukraine, and also the fact that Russia is probably going to try its best to basically upset Europe on when the embargo comes in. So I wouldn't rule out a shock, but what's most likely is that basically commodities start going higher again on supply constraint and cyclical revival, and that it doesn't necessarily affect inflation in 2023. So I think it's more like really typical like European vulnerability, the fact that basically there is no plan B for another couple of years for energy. And I think that the other side of that story as well is that you have to keep real yields, like probably like much more negative than what they should be to fight inflation in Europe, because you've got a chronic supply side shock that obviously will continue feeding. You have like PPI much higher in Europe than in the US. And that means it will continue to feed through CPI, because the problem is, when suppliers actually see, have like cost pressures, as soon as you get demand revival, you actually get like PPI feeding through to CPI, which is the basis for like calling a deflationary depression in Europe if the Fed was not stopping to hike and if the Fed doesn't pivot. And for me, what it means really is that eventually, I think Europe, whether Europe needs to finance investment, this is the case for US as well. I mean, you need investment in obviously like energy sovereignty. You need investment into reshoring, get less dependence on China. I could go on about that for ages. But the problem is when you need real investment is that you also need very low real yields. Otherwise, the risk is you're going to see your debt to GDP ratio explode. So for me, the only pass out, and I think I was worried it would happen imminently, but instead, if the Fed actually does pivot, I think it will be much more of like a slow drip. But I think what will happen in Europe, especially, sterling, same thing, and Australia probably as well, is that what will happen is you're going to devalue your currency versus the dollar and versus gold. And so gold is really the one thing I'm super bullish on in next year, but more versus euro and Aussie sterling than just like purely versus dollar.
Talk me through the whole Europe situation, how you think it plays out economically, because I mean, it's really complicated because you've got these high prices, they're structural. They need investment, They need fiscal stimulus because the population's getting hurt by the high prices. You need to have investment of whether it's building out EV capabilities or, changing infrastructure to Algeria and, other places to get gas. So there's a lot to be done, but that seems like it might keep inflation higher as well. This is why you think, well, the only valve here is to let the euro keep falling.
Yeah, I mean, that's exactly what I'm saying. It's not happened this year because I think, and that's something that the ECB published this week as well, is like inflation is incredibly unequal, right? It basically hits the ones that are spending most of their earnings. So I think that the first goal is always to fight inflation. And that's also what's politically correct and what's politically demanded. Well, that's only until people start losing their jobs. And I think that's not a chart that I could send you the chart later to put on screen. But what's really interesting, if you look at economic lags, is that really what will happen in 2023 is that we're moving from being worried about inflation to being worried about losing our jobs. And I think for me that's really going to be the year where compromises, especially outside the US, have to start being made. And I'm talking about the ECB. That's already what the Bank of England has been doing by like hiking 75 basis points, but basically saying, oh my God, we're never going to get as close to what markets are pricing. For me, this is exactly the story. You cannot afford to basically head into deflationary depression. And there's a time as a central bank where you basically only look at the risk of higher inflation, and at some point it becomes binary, right? You basically either have really continued high inflation or you basically have deflation, and that's a much bigger risk, which is now rising, which means that basically you're going to have eventually to compromise and let inflation run a little bit hotter for longer, to basically save your jobs.
So what risk?
And that's when I see that happen in 2023.
What risk do you have a little bit further out here of Europe having a deflationary bust out of the end of this? Or do you think it eventually resolves itself in a way that's more benign?
Well, I mean, it will sort of depend on the ECB, but if you're actually trying to, it's a Sisyphean battle at this point to basically for anyone outside the US to basically try to suppress supply side inflation, in commodities that are actually priced in dollars, where basically the Fed is keeping the dollar super tight. So you're inevitably going to massively over tighten if you're trying to target inflation. It just doesn't make sense. It makes sense at the beginning because you want to anchor expectations. And actually, that's a good point you're making, because expectations are not anchored in the UK. They are anchored in Europe. In Europe, basically, inflation expectations have peaked over the Russian war, and it's not really coming down fast, but at least we're not going up anymore. UK, we're basically still going up, and you can see it. There's much more inflation pressures in the UK. I mean, I basically traveled the whole time between London and Paris. You definitely see a lot more inflationary pressures in London than Paris. For me, it's the compromise that will be made, and has already been made by the Bank of England. I think the Bank of England has already told us they would prefer to devalue sterling than basically head for deflationary depression.
Yeah, I mean, these are not easy choices, but it feels that way. I feel like there is
not easy. I mean, for me, it's
what seems like a messy, complicated backdrop for Europe. you're actually saying you're bullish European equities. Talk through that for people to explain it, because it's counterintuitive. I think when people hear this, they're like, oh, Europe's broken, you can't invest in anything. But you're saying actually equities may outperform. Talk about that.
I mean, firstly, the first thing I want to say on that is any emerging market that's actually devaluing their currency is basically buying nominal growth, right? So what you have, like very often in an emerging market crisis is the currency devalues and actually equities are doing really well. So it's I don't think it's counterintuitive. And in fact, if you're considering what we call what some people have called like a industrial war between Europe and US, which Macron have been calling this week, and French finance minister also have been saying that the inflation act is unfriendly. I think the only way you can fight, given you're massively constrained on energy, is basically by devaluing your currency, and basically you're basically buying market shares. It's just like going back to the old FX war, but in a different way. But for me, it's the only way to fight the sort of US war that's been waged on Europe, literally.
But do you not then generate higher inflation costs because commodities are priced in dollars? I mean, is that not shooting yourself in the foot, which is the UK is seeing?
I mean, you are generating inflation, but it's sort of like a slow drip of inflation, and you just have to make the choice that it's better than depression, and it's sort of like buying you time to actually launch much necessary investment, and that's what's needed in Europe, is basically deeply negative real yields, so that you basically fix them because the other problem in Europe is you've got countries like Italy where you already have really high public debt, which is obviously the issue with borrowing. So in a way you just don't have another choice. The flip side literally is losing jobs, losing the industrial war, and you've done nothing to help on the energy side. I mean, Mrs. Lagarde can talk, as much as she wants about basically countering inflation, but she's not going to be printing energy. The only thing that can print energy is basically to have deeply negative real yields, so that there's basically an incentive for investment.
We're looking at an era again of these rolling competitive devaluations of currencies to stabilize their economy. And so you think the euro has further to decline, or we shouldn't be looking against the dollar? You mentioned before, some currencies will be different, and maybe gold is the anchor currency of which to look against these competitive devals. And that's what tend to work in the past. The gold versus, I use a basket of 27 currencies. It actually works really well for this kind of stuff, these rolling competitive devals. So that's what you're thinking, right?
Yeah, I mean, it's a shame we've lost the crypto space because that would have been an amazing environment to actually start getting.
It'll be back. I think it comes back as negative real rates.
Yeah, I mean, I bought some yesterday, but I don't expect it to be I don't expect it to go on an amazing holiday for Christmas with it. It's sort of what, why not? But yeah, so I'm basically using the real anchor, which has worked now for decades rather than years. And obviously, the reason I'm using gold is because I was expecting a Fed pivot to be priced in the next few weeks. So I thought, I'm keeping that view because it's a strong view that I've basically been holding all year, that the dollar was so massively superior, whether it was going to be on one side of the smile or on the other side. But obviously, cyclically, the dollar will weaken. And I think it's better to basically express the same view versus gold than versus dollar. But I still really think that there will be a point, maybe early next year, where you just want to go back long dollar.
Yeah, it feels like we've got a decent correction now, but at some point we
Yeah.
still didn't finish the business of
Yeah,
the strong dollar, because that global issue with the tightness of dollars around the world is not going away. I mean, I
yeah,
don't know
I agree.
how we're going
I
to get
agree.
rid of this.
It's going away for a couple months, but it's not going away for forever for sure. And I do agree that it's unfinished business there. I don't think the dollar will peak here. So we'll see how that all hangs together. But the way I'm thinking right now is it's not the best way to play the Fed pivot. For me, the best way is absolutely equities and commodities. The dollar is probably like second best. And the same thing as on fixed income as well. I don't think you're going to get massive bang for your bucks in fixed income, and in fact that's what happened yesterday. I mean, really, by far the superior trade was going long equities, and also that's where I got the most pushback from clients. Really, I think everybody still hates risk, and I should do a model on like getting pushback from clients, because that's always the trade that everybody hates work the best.
I mean, I've been arguing this for a while that I'm constructive equities, and I've never seen as much negative sentiment in my entire career. I mean, everybody thinks this is 2008. I'm like, what is going to cause something like that? What's going to cause this massive deleveraging? But people are unbelievably bearish. And I just thought, well, any marginal rate of change, i.e., as you said, the pivot, I've been looking for exactly the same thing, and equities take off because everybody's massively underinvested.
It's an inflation story as well. I mean, not just deleveraging. It's like suddenly if you're losing the reason why the Fed is going to be killing you, then, it's gone. So we'll see but I'm pretty sure that will come down very fast. And, if we didn't, I don't see any reason why we wouldn't.
And so cyclical equities outside the US, commodities potentially, but you really like gold here. That's kind of where we come to in trades. And what kind of time horizon we're talking? We're talking the whole of 23 possibly in this?
No. I'm always focused on the next sort of like couple months, and I'm reviewing, what I'm saying and my recommendation literally every day. And when something change, I change my mind. I would never say like something will happen for the whole of 2023. Experience tells me that it's never the case, and something will come and like.
Okay, because again, it's really important. It's really important for people to know the time horizon. So we're talking here. 2-3 months.
What I'm looking at is, so let's say SPX 4,200 by the end of the year. Then there's a big trend there. If I'm right that we are in a soft landing, which, at the moment I think I am, then, potentially we can go back all the way up to new highs into 2023. But, if whatever happens, and we don't get soft landing, then I think 4,200, I'll change my mind, go back short. Time will say. And if I told you everything for the next 12 months, then you wouldn't have to pay me to tell you every month what's happening. So, so that's why I would have said anyway.
Juliette, fantastic conversation as ever. Lots to chew over and think about. I love the fact that you're approaching it differently than most other people. And, I take that very seriously when I see somebody I respect doing that. And I think it's something people should listen to, because everyone's very tied to one narrative right now. And I think that narrative is probably wrong. Whether it ends up being a soft landing or even a harder landing, but a faster one, which is my view, I think the market's trying to look through the other side. So we'll see. We'll see. And again, as like you, maybe things change and maybe it gets ugly again. We don't know, but it's going to be an interesting few months anyway.
So, if your followers want to follow me on Twitter, my handle is @JulietteJDI. And, if you're institutional or high net worth, please get in touch. I tend to get the turning points right. And when things change, I change my mind. I never get married to any view. And that's why what my clients like about what I'm doing.
Fantastic. Juliette, as ever, great to see you, and talk soon.
Yeah, see you soon.
So what do we learn here from Juliette? Well, Juliette, as I alluded to at the beginning, has a different view. Her view is that the US economy is going to potentially avoid a recession. The Fed are pretty much done now, and the pivot to her means no more tightening. So that means that equities do pretty well. I mean, she's pretty bullish equities, which again is pretty rare. She's bullish fixed income, but more bullish equities than she is fixed income. We talked a bit about Europe and China. So China, she thinks that at some point reopen, and that may change the supply and demand balance for the global economy and keep commodities performing relatively well over the next phase of the cycle. But she doesn't think that's inflationary, which again is a divergent view to most, because most people say, well, commodities are going to go up and therefore inflation's coming back. And her argument is much like mine, is commodity prices rising doesn't necessarily lead to inflation. It depends how fast they rise. You know, are we going to see a crisis again? Obviously, there's a potential, but it's less likely. But when we come to Europe, she's, again, got a really interesting thought process here, which is like, Europe has no choices here because of this supply shock. They're going to have to run negative real rates. And if they run negative real rates, they're going to see a weaker currency. And that probably European equities, particularly cyclicals, will do very well in that environment. And we talked a lot about a competitive rolling devaluation. We've seen this in currencies since about 2008. We've seen this ongoing rolling devaluation. And her view is, well, when you're benchmarking this, because at various points the dollar will get weaker too and then stronger again, is that gold probably does very well. So gold is very out of favor. And so she's looking at gold as well, saying, well, if everybody's going to keep devaluing other currencies, then gold versus euro, gold versus Aussie, gold versus the pound, it should do really, really well. So again, I think that's another interestingly different view from others. So let's see how this plays out. Her time horizon, which is always an important question to ask, is actually quite short term. So she may think that the trends might continue, but her real thought is, okay, here's what I think to be true for the next 2 months, maybe 3 months. So let's see how it all plays out. I hope it was useful.
Hey there, revolutionaries. To join a community sharing insights like you just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.